Welcome to Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. This week, we examine two economic issues in the news. In the second half of our show, former chief economist of the U.S. Department of Labor, Diana Furchtgott-Roth, looks at the politics of minimum wage. Up first, former White House counsel Peter Wallison, now at the American Enterprise Institute, is out with a brand new book that may change your perspective on the causes of the housing and banking crisis that he astutely predicted. Peter, welcome to the show.
Great to be with you, Bill. Thanks very much.
Peter, your new book, Hidden in Plain Sight, does a deep analysis of the 2007-8 financial crisis, and you pose the question, was it insufficient regulation or government intervention in the mortgage market that caused the problem? Take a moment and lay out those two opposing narratives for us.
Yeah, in fact, what the American people have heard about the financial crisis, through the media mostly, but also from people in the government during the Obama administration, is that it was caused by insufficient regulation of the financial system in general, particularly banks and other large members of the private sector. That is the narrative that supports, and did support at the time, much more regulation of the financial system through the so-called Dodd-Frank Act, which was adopted in 2010.
And what's the other point of view that you take up in your book?
The point that I look at mostly in the book, and what the book is really about, is to show the contribution of the government's own housing policies to the financial crisis. And what I conclude in the book is that the narrative that we have been told since 2007, 2008, and through the financial crisis, that it was the fault of the private sector and lack of regulation, is false. Actual events were caused by U.S. government housing policy, principally the affordable housing requirements that were imposed on Fannie Mae and Freddie Mac, two very large mortgage companies operated by the government or controlled, regulated by the government. And those rules were imposed on Fannie and Freddie in 1992.
Well, before we get to that, let's create a little context and go back in history. You know, in your book, you claim that it's hard to find any instability in the financial system over the past 100 years that wasn't caused by government policies. Give us a few examples through history.
Well, I think one of the things that we remember very clearly, at least in recent times, is the fact that the S&L system collapsed in the late 1980s and early 1990s. The savings and loans were a government program, that is, banks or bank-like institutions that were set up for the purpose of supporting the housing market. And they simply fell apart in the late 1980s and early 1990s because of the way they were structured. So that's one example of the government interfering in the market that caused a very substantial period of loss. We had a kind of a recession in the late 1990s. Late 1980s and early 1990s, which was caused by what happened with the S&Ls.
And we're still paying those bonds off.
Yeah, that's right, and will continue for many years.
You mentioned Freddie and Fannie. Take us through the creation of Fannie and Freddie from the beginning, and then talk about how their mission evolved after the S&L fiasco, when they were there to make sure it would never happen again.
Fannie was formed during the New Deal. Fannie was formed with the notion that if you could help the banks to sell their mortgages to some other organization, then they would get the money to make more mortgages. It was a way of helping the growth of the housing market in the United States. And it wasn't actually a bad idea. The trouble was that, of course, the government had to buy those mortgages from the banks, and that caused budgetary problems as the country approached the Vietnam War in the 60s. So Fannie was, at that point, privatized. That is, it was allowed to sell its shares to the private sector, and it became kind of a government-sponsored enterprise. It would continue to be backed by the government, but it was owned by private shareholders, and it actually listed its shares on the New York Stock Exchange.
And there was an assumption that the government would never let them fail, so didn't that give them access to low-cost capital?
Yes, it did, and that was one of the ways that Fannie and Freddie came to dominate the market. Freddie Mac is exactly the same as Fannie Mae, exactly the same kind of institution, but it was set up by a different government agency and, in effect, privatized shortly after Fannie was. And both of them were seen in the markets as backed by the government. And in that case, most people thought, most investors thought, there was very little risk in lending money to Fannie and Freddie, so they were able to borrow money at much lower rates than anyone else, and that allowed them to come to dominate the markets completely by the mid-2000s.
How did these two organizations end up with such incredible power over Congress and congressmen?
Well, one of the reasons was that they had a broad constituency that was very much in favor of what they were doing. Realtors, home builders, and to some extent the banks themselves all liked the idea that Fannie and Freddie were in the market with securities that were seen as backed by the government, because it then became very easy to sell those securities and to use the funds that were being generated in that way to do more building of homes and selling of homes, and in the case of banks, an opportunity for them to trade these government-backed securities, which was also very profitable for the banks. So Fannie and Freddie got to be very powerful in Congress, not only because they were seen as keys to increasing home ownership in the United States, but because many major industries, like the realtors, the home builders, and the banks, were supporting them and willing to support congressmen and senators who supported Fannie and Freddie.
Let's look at how Fannie and Freddie worked before things got out of whack. You mentioned something called the 3 C's of credit underwriting. What are those, and how are they measured for home mortgages?
The 3 C's were a very simple way of describing the underwriting standards that Fannie and Freddie and most good underwriters of home mortgages used. The first C was collateral, which referred to the value of the home. And when you bought a home, you put down a certain amount of down payment.
It used to be 20%.
And that was the collateral. The second part was capacity. And that was your income in relation to what you were going to have to pay each month in order to sustain that mortgage. And the third was character. And that was what you have shown in the past as your ability to pay other obligations that you had, not just your mortgage, but other obligations.
Yeah, did you pay your bills?
If you had paid your bills, generally over time, you were seen as having character. So those 3 items were the 3 C's of credit.
And home ownership under the old regime went up to what, 60, 63% or something?
Yeah, well, actually, under the old regime, up until 1992, when the affordable housing requirements came into being, the home ownership rate in the United States was 64%, and it had been 64% for 30 years. It started out in the middle 60s, about 64%, and by 1995, it was still just about 64%.
So the system seemed to work pretty well up until then. What role did the Office of Housing and Urban Development play in directing the policies of Fannie and Freddie going forward?
When the affordable housing requirements were adopted by Congress in 1992, HUD was given the ability to administer the law and to change the requirements. The law actually, when it was adopted, said that Fannie and Freddie had to purchase, when it was buying mortgages from banks and others, and that's how Fannie and Freddie operated. They didn't make loans themselves. They simply bought the mortgages from lenders like banks. And when they bought those mortgages, according to the statute, 30% of those mortgages had to be made to borrowers who were at or below the median income in the place where they lived. Now, 30% was something that was probably pretty easy to do. You could always find prime mortgages for people who were below the median income, but 30% was about the maximum that you could find without starting to reduce your underwriting standards. Yet, HUD, over time, beginning in about 1995, began to grow those requirements so that by the year 2000, 50% of all mortgages that Fannie and Freddie bought had to have been made to people who were at or below the median income. And by 2008, 56% of all mortgages that they bought had to be made to people who were at or below the median income.
So the customers were getting dicier and dicier. And then there's something called the Community Reinvestment Act that came along.
Actually, the Community Reinvestment Act was adopted in 1977, but at the time it was adopted, the standards were rather loose. banks were required to go out and find borrowers in the areas that they serviced who were below the median income. At the time, the law did not require them to make any particular number of mortgages, but simply to reach out to people of low income in their communities. And banks did that, but not to a very great extent because it was very hard to find quality mortgages.
This was the anti-redlining sort of activity that was going on?
This was intended to be anti-redlining. Mm-hmm. It didn't work very well. And the Community Reinvestment Act was never very important until 1995, when the Clinton administration set quotas for Community Reinvestment Act, CRA kinds of loans. Those quotas were never specified in any percentage amount, but when examiners examined what banks were doing, they would classify whether a bank was doing well or not doing well in making CRA loans. And if it was not doing well in making CRA loans, the penalties could be very severe. You might not then be able to get any approval for mergers and things like that. So banks felt it was very important for them to comply with CRA, but we have really no data that shows us the degree to which CRA was used. We do have good data for the affordable housing requirements, which were essentially the same thing and were openly required of Fannie and Freddie. And we now have a lot of data about what Fannie and Freddie had to do in order to meet the affordable housing requirements.
And what did this do to loan standards and to the creation of the market for non-traditional mortgages?
Well, as the Department of Housing and Urban Development continued to tighten the requirements under the affordable housing goals, Fannie and Freddie had to go deeper and deeper into the subprime and other low-quality mortgage market in order to find the borrowers that they needed to meet those requirements. When the requirements went over 50%, it became very, very difficult for them to do so. So that by 1995, for example, they were already accepting loans with 3% down payments, when up to 1992, they would never accept a loan that was less than 10% down payment. By 1995, they were accepting 3% down payments. By 2000, they were accepting 0 down payments.
And how did these policies drive potential homeowners who might have qualified for prime mortgages under the old rules into bigger homes backed by subprime mortgages?
Well, of course, what happens when you reduce underwriting standards is not only that you are able to make loans to low-income people who don't have good credit records or don't have the necessary down payments, is that everybody gets an opportunity, even people who could be prime borrowers. Everybody gets the opportunity to get a very favorable loan. Let's take, for example, what would happen if you had, say, $20,000 for a down payment. When the required down payment was 10%, as it was up to 1992, then you could buy a $200,000 house. But if down payments went to 5%, you could then buy a $400,000 house. Much more leverage, much more borrowing, and much more could be spent on homes.
So the real estate industry loved it.
Of course they loved it, and so did the realtors. And that was something that drove the growth of a huge bubble in the housing market during the years when Fannie and Freddie were dominating the market, because as they reduced their underwriting standards, house prices began to rise very fast because many, many people got access to much more credit to buy homes, were bidding for more expensive homes, homes got larger, and we had a massive housing bubble, which ultimately collapsed in 2007 and 2008.
Did anyone keep track of how much money was loaned to unqualified buyers so they can see what their default rate was over time?
Well, one of the problems here was that Fannie and Freddie were never, during the time they were still operating before they'd been taken over by the government, they were never very candid about the subprime and other low-quality loans that they were making. Fannie and Freddie began to make substantial numbers of subprime loans beginning in the early 1990s and right up through 2008. But until they were taken over by the government, they never revealed how many of these subprime loans that they had been making, because they interpreted a subprime loan as a loan that they bought from a subprime lender, not the quality of the loan itself or its characteristics, but rather who they bought the loan from. That misled the market tremendously because most people in the market, in fact, I doubt that anyone in the market, I never was able to find anyone who actually understood how many subprime loans Fannie and Freddie had made beginning in the mid-1990s up through 2008. People didn't understand how risky the market had become because Fannie and Freddie were buying all of these mortgages.
Well, is this because the market was deregulated and no regulators were watching?
Even the regulators didn't have, first of all, let me stop for a moment and say simply, there was no deregulation in the financial markets of any significance beginning in 1935. I mean, from that period forward, regulations of banks and others tightened more and more so that it was very difficult to find any kind of deregulation that occurred up to the financial crisis.
Well, people point to the relaxing the GlassSteagall rules as being one of the causes of the crisis.
Well, it's very hard to see anything in the relaxing of Glass-Steagall that could be identified as a cause of the crisis. For example, the institutions that got into trouble, commercial banks, got into trouble by making very bad buying, very bad, and holding very bad, low-quality mortgages, and so did investment banks. They also got into trouble for the same reason. They all bought and held, thinking they were good investments, these very low-quality loans. So even if the Glass-Steagall Act had never been reformed in any way, it wouldn't have had any difference in 2008.
Well, you talk about how highly regulated it is. There are bank capital and accounting rules that everyone must follow. I think they're called the Basel Accords. How do these evolve? And talk a little bit about the unintended consequences of driving entire sectors of the financing industry into the same asset classes.
In the mid-'80s, the world's bank regulators got together to establish uniform capital requirements for banks. I think there was some concern at the time that some regulators were less stringent in the capital requirements that they had put in place for their banks, and that represented unfair competition for the banks that were in countries where the regulators were strict. So all of the regulators got together and they established in the mid-1980s a set of regulations that were called risk-based capital requirements. I won't go into the details of what was risk-based, but all banks, certainly all large banks around the world, were all subject to the same risk-based capital requirements. In those requirements, mortgages had a favorable place. If you were making a loan to a corporation, say to IBM, 8% of that loan had to be kept back as capital on your balance sheet. But if you were making the same amount in mortgages, only 4% had to be kept back on
because
your
housing
balance sheet.
prices never go down.
Well, one of the things it did was favor making mortgages over making commercial loans. But things got a little bit worse in the early 2000s when the regulators decided that they would provide even more favorable terms for mortgage-backed securities. And in the case of mortgage-backed securities, these are pools of mortgages as to which an issuer would create securities and sell securities to investors. The investors would then receive a payment based on the principal and interest that is flowing into that pool of mortgages from the mortgages that were made to millions of borrowers.
And these were believed to be safer.
These were believed to be safer because they were much more liquid. You can much more easily sell a security backed by mortgages than you can sell a bunch of mortgages because people have to look at all of the mortgages. But when the securities are backed by a very large number of mortgages, the assumption is that the security is much safer. So it was much easier, more liquid to sell securities, and as a result of that, the bank regulators gave them a better capital requirement.
So they drove the whole industry into the same asset class. And I understand Citibank managed to stash $1.2 trillion in loan assets off its balance sheet, holding almost no capital against losses because of this?
Yes, well, that was something that was permitted by the
regulators.
By the regulators. I don't think the amount was $1.2 trillion. That is a mistaken amount. That is what Geithner put in his book. But in fact, I think the total for all of the banks was probably something like 1.2 trillion,
okay.
because many of them did exactly the same thing. But when those mortgages began to fail, the banks were required to bring those mortgages back on their books, and that was very troublesome for the banking industry.
So how did the political left become so invested in defending Fannie and Freddie's housing policies right up to the day the disaster hit?
The political left is basically very favorable to government involvement in any part of the financial system or the economy. They prefer to have decisions that are made by the market, in most cases, made by the government. And what I think they were concerned about with Fannie and Freddie is that if it became clear that it was government housing policy that caused the financial crisis, as my book suggests, the answer from the political left is this was something they did not want the American people to understand. So there was a huge effort to make sure that when the blame was assigned for what happened in the financial crisis, it was placed on the private sector, and to the extent that the government was at fault, it was a minor fault because they just didn't have the power to regulate the financial system
they needed more power.
As much as they should.
And what role did the so-called independent media play in helping the public understand all this?
I don't think the independent media helped at all. They confused the public and, in fact, simply supported what it was that the government was saying. It was a very easy story for the media to blame the private sector because the people on Wall Street were making a lot of money. That was an attractive media story right there. And the government was telling them that it was the private sector that was responsible. To understand a much more complicated story would have taken a lot of research, which the media never bothered to do.
Well, it was also clear to a lot of people that the same folks were on both sides of the table. I mean, so many former bankers were in positions of power in the regulatory apparatus that they looked like the same people.
Yeah, I think that was true, but that is not something that would cause a lot of difficulty, I think. It is necessary in government to have people who understand how the private sector works. And I generally, having been in government myself and in the Treasury Department, in fact, for many years, I believe that the people who were in the government were honest and doing the best they could and understood, in almost all cases, exactly what was happening in the private sector and why it was necessary to control it. The fact is that before the financial crisis, the government had as much authority as it ever needed to control what was happening in the private sector. But the way that the government itself was behaving through its efforts to increase mortgages for low-income borrowers caused a complete collapse of an underwriting system that just also drew in private sector lenders such as banks, causing them to get into trouble themselves.
Because there was money to be made while the sun shined, that's for sure.
There was definitely money to be made because it was very simple, actually. Fannie and Freddie were the buyers of most of these mortgages. And so if you were a bank, you could assemble a pool of mortgages and then sell the mortgage-backed securities to Fannie and Freddie because they needed the mortgage-backed securities that were backed by these subprime and other low-quality mortgages in order to comply with the affordable housing requirements.
You note that the only entire U.S. industry that has ever collapsed was created, regulated, and insured by the government. I mean, in this case, as you point out in your book, over 3/4 of the non-traditional mortgages, the ones that went bad, were on the government's books when the whole thing came crashing down. After they've failed at all their jobs, we've given them even more power. What do we do now?
I think the only real answer, the only permanent answer for the housing finance system in the United States is to get the government out of it. There isn't any market discipline when the government is acting. And it is in the government's interest to make sure it is helping various constituencies. Every time we turn over a sector of our economy to the government, which is what happened with housing, we can anticipate that the government's social policies will produce some kind of instability over time. So my solution, of course, is to return the housing system in the United States to the private sector entirely and allow the private sector to set the underwriting standards, good, solid underwriting standards, 10% down payment and a good credit record and so forth, in order to assure that there aren't many losses on mortgages.
Well, Peter, I've been trying to make sense out of this for some time, and yours is the most sensible book I've read on the subject. Thanks for coming on the show.
Thank you.
That was Peter Wallison from the American Enterprise Institute, author of Hidden in Plain Sight, here on Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. To send us comments and feedback on this or any of our past shows, visit realclearradio.org and click on the email Bill link. Real Clear Radio Hour is a partnership with Real Clear Politics, one of America's top political websites. Ahead, former chief economist for the U.S. Department of Labor, Diana Furchtgott-Roth, dives into the politics of minimum wage laws. Stay tuned.